Mastering RSI. RSI is Relative Strength Index. Mastering Relative Strength Index for entries and exits. Do you know how to do that? I will show you in this video how to become profitable forex trader using the Relative Strength Index. The Relative Strength Index, RSI, is one of the most widely used momentum indicators in trading. When understood and applied correctly, it can help traders identify overbought and oversold conditions. It can help you spot divergences and time entries and exits more accurately. In this video today, I will break down how to use RSI effectively for consistent trading decisions. Now, let me start by saying and telling us what RSI is. So, the question comes that what is RSI? RSI is a momentum oscillator that measures the speed and change of price movement. RSI values range from 0 to 100. Then the standard settings is 14-period RSI. The key levels above 70% RSI is overbought. Potential reversal or to the downside is possible. Then below 30% is oversold, and potential reversal to the upside is also imminent. It's important to remember that an overbought RSI does not automatically mean price will reverse immediately, but it will ultimately reverse. What it simply shows that the trend is strong and may be ready for a correction. Now, how do you use RSI to identify overbought and oversold conditions? Overbought condition means that the RSI is above 70, while the oversold while the oversold position means that the RSI is below 30, and then the RSI indicator moves from 0 to 100. So you can see greater than 70 is overbought and less than 30 is oversold. So for the overbought position, which is greater than 70, price is pushing higher strongly, and is likely area for profit taking or short entries, best used in consolidations or weaker uptrends. Now, in the oversold one, price RSI is less than 30. Price is falling sharply. It's likely area for buying opportunity. It is best used in uptrends or strong support zones. RSI can remain overbought or oversold in strong trends for extended periods. So this means that you should always combine with price structure, support resistance, or multiple time frame analysis. So what this means is that don't just go and look at one time frame like 1 minute or 5 minutes and then see that the RSI is overbought, whereas in the 1 hour it is not overbought, it is even oversold. So that means you have to use multiple time frame analysis to be able to know what to trade. Now, how do we then look at the RSI divergence? We have looked at this in the previous video where I spoke about how to identify divergence. So this is one of the uses of the RSI, which is the divergence, and this is the momentum shift signal. Divergence occurs when price and RSI move in opposite directions. Bullish divergence: price makes lower lows, RSI makes higher lows. This is a possible upward reversal. In the next one, guess which you have bearish divergence. Price makes higher highs, RSI makes lower highs. This is a possible downward reversal. Then divergence signals are high probability setups when aligned with support, resistance, or trend lines. You see, this series of videos I'm doing at this time are advanced forex strategies, so please take note of that. Then let's look at the RSI entry and exit strategies. How do you enter and how do you exit using the RSI? Our basic RSI entry: you look for RSI to enter where oversold, less than 30% in an uptrend, so consider buy entry. Then look for RSI to enter overbought, greater than 70 in a downtrend, then consider a sell entry. RSI plus trend confirmation: you can use RSI to confirm a trend. Uptrend: buy when RSI dips below 40 to 50, and bounces. This confirms continuation. Then in a downtrend, sell when RSI rises above 50 to 60 and reverses. This is trend, that means the trend resumes. This avoids trading against the dominant trend. Then we also have the RSI and divergence entry. You spot divergence between price and RSI. You confirm with candle patterns, engulfing pin bar or breakout. Then you enter trade when price confirms reversal. For emphasis, this is Dr. Olubengade's YouTube channel. If this is your first time on this YouTube channel, please like this video, subscribe to this channel, and share the link of this video with your family and friends, and drop your comments and questions in the comment section below. Now, let's talk about the RSI exit strategies. You can use the RSI to exit a trade. And number one way to do this by targeting neutral levels. For example, exiting longs near RSI 50 to 60 in strong uptrends. Then trailing stop exit. Follow price trend while RSI remains above or below certain thresholds. Then you can also exit using RSI by divergence exit. If RSI shows divergence while price continues, consider closing part of the trade. Now, let's look at advanced RSI techniques. Please pay attention here. For information, I do Forex account management. So if you have capital and you want me to trade your Forex account for you, you can contact me. And then we can discuss the modality, and then we can share the profit at the end of every month. Advanced RSI techniques. Number one is RSI failure swings. RSI makes a higher low above 30. That is bullish. RSI makes a lower high above 70. That is bearish. Signals strong momentum continuation. That is RSI failure swings. Then we also have the RSI levels adjustment. In strong trends, adjust RSI levels. In a bullish trend, it goes to overbought 80. In oversold 40. That is RSI levels adjustment. You can adjust it. Now, in a bearish trend, overbought becomes 60. So oversold will be 20 because the market is bearish. So this helps to avoid false signals. Then we have RSI plus multiple time frames. So as I said earlier, don't trade RSI with just a singular time frame. Use multiple. And what you do here is check RSI on higher time frame to define trend. Check it on daily, check it on weekly, check it on 4 hours. Then enter trades on lower time frame with RSI pullbacks or divergence. This filters bad entries and improves win rate. Common mistakes traders make with RSI. Entering trades solely based on RSI overbought, oversold. You don't enter any trade only using RSI. You have to combine it with other indicators. Let's say, for instance, you can combine RSI with a pin bar. The RSI is showing this, pin bar is showing this. Then moving averages also is showing a cross at that point. Then another mistake is ignoring trend direction. Don't ignore trend direction when trading RSI. Then ignoring divergence and confirmation. Don't do this. Then using default RSI levels in strong trend line markets. In strong trend line markets, you may need to adjust the RSI levels to 80 and 20. Then exiting too early or too late without proper stops. Now, let's put it all together in one place as a summary. You define trend using the RSI, higher time frame. Look for RSI signals that's pullback, oversold, overbought, divergence. Then confirm with price action, support, resistance, trend line, breakout. Then enter trade with proper stop loss. Then manage exit, that is trailing target levels or divergence signal. By following this process, RSI becomes more than a simple oscillator. It becomes a complete trading tool for entries and exits. If you want more practical trading guides, chart analysis and signal setups, please subscribe to this channel, like this video, and keep coming back to this channel for more content like this. On this channel, I teach you how to make money online and offline. So please take action on what I teach, and then you'll be glad you did. I will see you in the next one. Before then, this video popping up from my channel by the side here is the next one you need to watch now. See you in the next one. Bye for now.